Good afternoon and welcome to Prime Interest. I'm Perianne Boring here in Washington, D.C. Let's get to today's headlines. Call your mom and dad once in a while. That's what the world's most powerful monetary manipulator told Princeton grads over the weekend. That would be Chairman Ben Bernanke, once a Princeton professor himself. Other pearls, if your uniform isn't dirty, you haven't been in the game. Well, after 4.5 years of near-zero interest rate policy, aka Monty printing, we're afraid to see just how dirty the chairman's uniform is at this point. But don't worry. After channeling poet Robert Burns in Forrest Gump, the chairman closed in true Truman-esque fashion. Give 'em hell. And that's about what we can expect once the Fed tapers away the punch bowl. I'll be talking about the Fed and gold with Peter Schiff in a bit, and Prime Interest producer Justine Underhill will present a chart to explain just exactly what the Fed has been doing vis-a-vis QE. And in the U.S., the big banks have had to submit living wills to regulators. This is basically a blueprint for their wind down should they become insolvent. Or maybe I should say more insolvent. But the Central Banks of Central Banks, which is the Bank for International Settlements, just came out with its own plan for how to deal with too big to fail. It's simple, they say. Just let the creditors and depositors take the losses. With Cyprus, and force the creditors to recapitalize a new banking entity. But this presupposes the creditors have the money to do this. After all, if too big to fail goes down, we're assuming all is not well in the land of Oz. And here's what's in your prime interest. Gold is the largest commodity market in the world. According to the World Gold Council, there are more than 150,000 tons of gold in existence. Of that, central banks hold 30,000 tons in their vaults. However, central banks have started lending some of their gold to bullion banks, banks that are licensed to deal in gold and silver. This is not a very transparent process. Central banks publish their gold purchases and sales, but they do not release any statistics on the amount of gold loaned and swapped into the market by central banks. I spoke earlier with Peter Schiff, the founder and CEO of Euro-Pacific Capital, and he gives us the breakdown of the relationship between bullion banks and central banks.
Well, central banks own gold. I mean, all the major central banks still hold gold. I mean, it's the only monetary asset that banks have other than other fiat currencies. So gold is still functioning as a reserve. I believe that most central banks don't have enough gold as part of their reserves. They have too much of other central banks' IOUs. But to the extent that central banks have gold, the way they trade it with one another is through these bullion banks. And of course, if they want to loan their gold out to generate a return, because if you have dollars or euros or yen, you can make loans and you can earn interest, although the interest that banks earn now is quite low. Many of them, though, will buy longer-term bonds to get more interest. But if you have gold, there's no way to earn any interest on your gold deposits unless you can allow them to be loaned out. And I think the bullion banks facilitate central bankers loaning out their gold. But part of the problem is once they've loaned their gold out and they still count it as if they owned it, what happens if they can't get it back? Because right, whoever borrowed it from the central banks has sold it, and they don't own it either. So they have to get it back in order to return it to the central banks.
Right, so I mean, this process is done through the gold carry trade, which was developed in the 1980s, enabled central banks to earn money on the gold reserves by leasing it out to the bullion banks. So, what brought about the need for the gold carry trade? Were central banks in need of money?
Well, central banks are always trying to generate profits. I mean, most of the central banks pay the profits over to the government, but they're able to keep a certain percentage. You know, those bankers have pretty lavish lifestyles. But there also are people who believe that there's something more sinister going on, that the central banks are trying to depress the price of gold. And one of the ways they do that is by making their bullion available to speculators who will borrow it and sell it into the market, therefore depressing the price, because they want to maintain, you know, a lower gold price so that there is more of a false sense of confidence in the fiat system that they're all profiting from.
And something really interesting in the markets right now that we're seeing is record low gold prices, but record high premium prices for delivery of gold. Is this a sign that the commodity exchange of markets and funds and futures, that they don't have the commodities to back up the trades?
Well, we don't have record low gold prices. I mean, not even close. I mean, the price of gold has come down recently, but it's nowhere near a record low. Gold is still pretty high. But what you're saying about premiums is true. You know, I run a physical precious metals company, Euro-Pacific Precious Metals. And when the price of gold dropped sharply, what was it, a month or two ago, there was a big spike in the premiums that we were having to pay to buy gold and silver bullion, especially in the smaller denominations, in 1 ounce coins, small bars. The premiums were much higher, and that's because the investing public responded to the lower gold price by wanting to buy more gold. But there wasn't as much gold being fabricated. The mints hadn't made it, manufactured it. So the premiums went way up because demand went up. And, you know, over time now that premium is starting to come down because maybe the mints can try to ramp up production to meet the increased demand. All of the liquidation was coming from the speculators who never really take physical delivery. You have a lot of people who owned exchange-traded funds or people who had futures positions. They were squaring off their positions or selling off their ETF holdings. They never had physical delivery. They didn't get physical delivery, so they didn't have any physical gold to sell. They just had paper gold. But the selling in the paper market drove down the price in the real market, and all that extra demand was too much. It overwhelmed the physical supply, and so the physical market never saw as big a price decline because some of it was offset by the increase in the premiums for those products.
Yeah, and I want to get into another factor is that with interest rates being low, and they've been low for several years now, you know, what these bullion banks were doing is taking the gold, selling it, and then using that money to buy something safe like a government bonds. But now that's obviously not profitable with interest rates being so low. So are we seeing the bullion banks selling the gold and then use that money to buy something less risky? Or I mean, more risky?
Well, I don't know what. Well, I think they're buying things that are more risky. I mean, they can't do anything so-called safe because there's no yield. I mean, if they just plow the money they get by leasing their gold into U.S. Treasuries, they're barely going to get any yield, and I think they're taking a tremendous amount of risk. Of course, the biggest risk of all might be that they never get their gold back, because that's going to be the problem. And if you've leased out your gold, you don't actually have it. What you have is a promise to be repaid your gold. Just like when anybody makes a loan, you run the risk that the borrower doesn't pay you back. So if you're a central bank and you've loaned out your gold, you run the risk that whoever borrowed it from you can't pay you back. And, you know, if there's a rush for the central banks to get that gold back, prices could go up dramatically as banks look to replenish reserves that were lost. They thought they had them, but maybe they didn't because a loan went bad. Or maybe whoever shorted that gold and they need to return it to the central bank, they need to go into the market and buy it, and the price could be a lot higher.
Well, according to the World Gold Council, central banks have been buying increasing amounts of gold recently. Do you think, why do you think this is, despite the fact that central bankers are openly hostile to gold?
Well, they might be openly hostile, but privately they know that they need to own it. You know, I think that they're trying to keep this system going, this fiat system going, but they have to know that it's going to come to an end someday, and they want to make sure they have as much gold as possible when it does. You know, whoever has the most gold when the music stops is going to win. And I think a lot of these emerging markets know that better than any of these central banks, because they are swimming in paper reserves, and they barely have any gold. And so they really need to take any opportunity they can to try to convert what could be worthless paper into very valuable gold.
In March of this year, J.P. Morgan settled a case. Well, a case was dismissed, a class action lawsuit against J.P. Morgan, HSBC. They alleged they were suppressing and manipulating the price of silver on the COMEX. However, the district judge acknowledged that J.P. Morgan had the ability to influence prices. The banks did not dispute this. Could it be, that J.P. Morgan, has special privileges to manipulate the price of commodities?
Well, they can go to the Fed discount window, so they can get money for cheap from the Fed, and they can use it to short gold and silver if they want. So they certainly can influence the markets in the short run. I think over the long run, it's not going to make a difference. I think the price of gold is going to go up regardless of what individual banks might try to do to influence that price in the short run, whether they're trying to suppress it or they're trying to make it go up. And, they're trying to make a profit for themselves, too. So if a bank can influence the market to profit, then it's going to do so. The problem is the central bank shouldn't be giving out money to certain organizations that they could use to try to generate a profit. I want to end that practice. That's why I think we should go back to a gold standard where you don't have that. You don't have free money being given out by the central banks to all the banker friends. You have real money that has to be earned, has to be mined. It can't just be created out of thin air by government and given out to their friends.
And how likely do you think it is that we'll ever return to a more stable monetary system?
I think it's very likely. I mean, if you look throughout modern history, the gold standard is the norm. Fiat currencies are an aberration. The one thing that's different about this particular time period is that this experiment in fiat currency is worldwide. See, historically, it's only been individual nations that have been dumb enough to embark on a fiat system. They've always ended in ruins. The whole world is now repeating this failed experiment, but it's still going to end in failure. And I think once it does, the world will turn to sound money again, because that is what's worked. It's proven to work. And if you believe in capitalism, if you believe in freedom and living in government, then you have to believe in sound money and the gold standard, because the two are mutually incompatible in that it's fiat money that enables governments to grow to these enormous sizes. They could never finance these massive deficits. Governments could never be so big if we were on a gold standard. That was a choice that Nixon made in the United States in 1971. He either had to stop growing government and balance the budget, or take us off the gold standard. And he chose the latter. We went off the gold standard so government didn't have to shrink. They can keep on spending money. They can keep on running deficits. But if we stayed on the gold standard, we couldn't have done any of that. We would have been forced to balance the books, slash government spending, and government would be much smaller today had we done that, and America would be far more prosperous. Unfortunately, we're about to have a complete economic collapse because of all the damage that has been done to our economy for these 40-some-odd years that we've been on a fiat monetary system.
And that was Peter Schiff, president of Euro-Pacific Capital and Euro-Pacific Bank. And stay tuned, because prime interest producer Justine Underhill is going to answer the $1.7 trillion question: where did all the Fed money printing go? Then prime interest producer Bob English and I will go at it over Iraqi oil rights and a European MP who calls the banking system a criminal counterfeiting scandal. We'll be right back.
I would rather ask questions to people in positions of power instead of speaking on their behalf. And that's why you can find my show, Larry King Now, right here on RT. Question more.
That was a new alert animation. It scared me a little bit. There is breaking news tonight.
We are continuing to follow the breaking news.
Alexander's family crying tears of joy and embracing each other that justice has been rendered in a court of law.
Found Alive is a story made for the movies, playing out in real life.
Each time the Federal Reserve engages in quantitative easing, it expands the monetary base. The monetary base is the sum of currency in circulation plus the reserves of the banking system, and it is one of the few things that a central bank can control directly. But where exactly is all the newly created money going? For more on this, I turn to Prime Interest producer Justine Underhill. Justine, could you tell us exactly how the Federal Reserve is defying science?
Sure. Well, the first law of thermodynamics states that energy matter can't be created or destroyed. It can only be transformed. And that's, in other words, you can't make something from nothing. And yet this law seems to apply everywhere except when it comes to the Federal Reserve. And we can see this in the graph of excess reserves at the Fed. And when the Federal Reserve System was created, it was all member banks had to keep a certain amount of cash on hand in reserve at the Fed. And banks could not get interest on this amount that they had at the Fed because banks shouldn't be getting paid to stay solvent. Yet in 2006, under pressure from lobbyists, lawmakers agreed to make interest payments on reserve money at the Fed. And this was slated to go into effect in 2011, but the start date was actually moved forward when TARP launched, and it launched the payments on interest on reserves in 2008. And as soon as the Fed started paying interest on these reserves at above market rates, you can imagine what happened. Reserves went up, but you might not be able to imagine by how much. And this graph shows excess reserves that are held at the Fed, and this is above the minimum amount required. And before 2008, reserves were fairly minimum because there was no incentive for banks to keep their money at the Fed. And in August of 2008, reserves were approximately $2 billion. That's excess reserves. And after interest payments were launched in October, reserves shot up to about $267 billion. And then just a few months later, in January of 2009, they were at $843 billion. And I just want to reinforce that in just a period of 6 months, reserves shot up by more than 40,000%. And the amount at that time sitting in the Fed was more than what Congress had approved for the bailout or for the Obama stimulus. And if that's not enough, reserves continued to go up over the years, and right now they're at $1.7 trillion. Now, the Fed did explain the reason for paying interest on excess reserves in a 2008 press release. They stated that this would permit them to expand their balance sheet. So how exactly does it do that? Well, when the Fed expands its balance sheet, and this line is the monetary base, it buys things, mortgage-backed securities, treasuries, and this is done by digitally creating money. And when this money enters the system, it has the potential to cause price inflation. And the monetary base from 2008 to now has increased by approximately $2.4 trillion. But if the Fed is taking in large amounts of money in the form of excess reserves or reserves, then that might counteract the price inflationary effects of money creation. So that's a $2.4 trillion increase in the monetary base and a $1.7 trillion increase in excess reserves to offset. Now, each time the monetary base increased from QE1, QE2, QE3, excess reserves pretty much increased accordingly. And this is because the Fed was pumping a lot of money into the primary dealers at the Fed and crediting accounts of banks at the Fed, which directly go into the excess reserve accounts. Now, the Fed has had to pay interest on all these excess reserves. So for those who say that this money, that QE hasn't had much of a cost, they're not taking into account the fact that the Fed is currently paying about $3.8 billion a year to the banks on these reserves. And once interest rates rise, the Fed will have to maintain higher interest on excess reserves to make sure that the money doesn't just flow out into the system. And the bottom line is that the Fed is currently paying banks right now to do nothing with their money.
This is so interesting, and we have to, make the important distinction between monetary policy and fiscal policy. Now, right now, you were just talking about monetary policy, but does this affect fiscal policy, specifically in respect to the debt ceiling and the deficits?
Well, periodically, the Fed makes remittances to the Treasury. It pays back all of its profits to the Treasury every so often. And with that, when it's taking out its money, it's taking out some of its profits to pay this interest on excess reserves. And so what it's remitting to the Treasury is somewhat less because of this payment system.
Now, Senator Bob Corker, at a recent hearing, he confronted Bernanke about the issue of increasing payments on issues on the interest on excess reserves.
Well, they're going to be yielding huge returns on their reserves as you pay the
We'll be paying market rates. We'll be paying exactly what they could be getting in the repo market, in the commercial paper market, anywhere else. There's no subsidy.
Justine, is the Fed really paying market rates?
Well, the Fed, in order to encourage banks to keep their money parked at the Fed, has to pay above market rates, and that's comparable to other riskless securities. Now, if you look at what the general collateral repo rate is, what the Fed is paying right now, it's similar to that, but it's actually, it's still substantially different. They're paying double the general collateral repo rate. So they're paying about 0.25%.
Great. Thanks so much for weighing in, Justine.
Thank you.
Joining me now is Bob English.
Great to be here. Tell me we're not done talking about central banks.
Oh, never.
Or central bankers.
So, well, we have a clip from Godfrey Bloom. He's from the United Kingdom Independence Party. He said some rather unheard of comments on the floor of the European Parliament. The first clip, he's talking about fractional reserve banking being a criminal scandal.
All the banks are broke. Bank Santander, Deutsche Bank, Royal Bank of Scotland, they're all broke. And why are they broke? It isn't an act of God. It isn't some sort of tsunami. They're broke because we have a system called fractional reserve banking, which means that banks can lend money that they don't actually have. It's a criminal scandal, and it's been going on for too long.
Bob, this guy sounds like UK's Ron Paul.
Somewhat, yes.
Do you agree with what he's saying?
A criminal scandal. It's been going on for hundreds of years. Here's the issue with fractional reserve banking, is that there are what's called maturity mismatches. In other words, the bank, you put money in your checking account, the bank can loan that money out for 2 years, 5 years, 10 years, but you can withdraw that money tomorrow. So the very nature of our fractional reserve banking system is that the rug can be pulled so that the rug can be pulled from underneath it at any time. And that means that it's inherently set up for the requirement of moral hazard. It's built into the cake here.
But isn't this how we get liquidity in the market?
Well, you get liquidity, and I mean, why is liquidity necessarily an end to itself? And that gets back almost to HFT. Is high-frequency trading a good thing because it adds liquidity? I mean, it's dubious, really.
Okay, and the next clip from this member of parliament, he goes even farther and he calls UE counterfeiting.
We have counterfeiting, sometimes called quantitative easing, but counterfeiting by any other name. The artificial printing of money, which if any ordinary person did, they'd go to prison for a very long time. And yet governments and central banks do it all the time. Central banks repress the amount of interest that rates are, so we don't have the real cost of money. and yet we blame...
This raises a very interesting point, and an important one, is that what is the cost of money? Well, those are prices that are baked into interest rates. Interest rates tell us, demand and supply for money. And unfortunately, when the central banks go about their monetary manipulation schemes of keeping near zero interest rates for 4.5 years, these market forces disappear, and we end up with a really distorted market.
You know, it's really interesting. I had the opportunity to go to a meeting at the Federal Reserve, and I actually asked the question, do they believe in price fixing? And they said, no, price fixing is bad, we don't do that. And I said, well, what about setting interest rates? Isn't that fixing the price of money? And they all looked at each other and couldn't even answer the question. They were like stunned that I had answered, that I had posed such a question. So, you know, it's interesting that we're seeing this happening in UK as well.
Yes.
So another question, though, is, you know, we're going to completely switch topics here.
Okay.
Why did we go to war with Iraq? You know, back in 2003, many speculated that it was for oil.
It was very evident to me that his goal was the Straits of Hormuz, which is where 17, 18, 19 million barrels a day of the world's crude oil goes out to the markets.
I said, we're going to war with Iraq. Why? He said, I don't know. The truth is about the Middle East is, had there been no oil there, it would be like Africa. Nobody is threatening to intervene in Africa.
Iraq was the chosen vehicle to do something big and bold, to take one of the centers of the Arab world, oust the government, bring about regime change, turn it into a democracy, and then based upon that, that would become a model for historic change throughout the part of the world, which is essentially has been the least successful part of the world.
Now, Richard Haass, he was a close advisor to our Secretary of State, Colin Powell. He might have hit the nail on the head with this one, because today the New York Times reported that it's not the United States who are the biggest benefactor from Iraq oil, but it's China. They are the largest importer of Iraqi oil out of everyone. So, sorry, that's all we have time for today.
That's okay.
You can follow us on Facebook at facebook.com/primeinterest. Please follow Bob on Twitter at EnglishPI, and you can follow me at Perianne RT. Thanks for joining, Bob.
Thank you.
Now, it was a suspect day here at Prime Interest. We were incredulous at our beloved chairman's candor to the senior class at Princeton. Do you think he calls his mom before each phase of serial money printing? And we couldn't believe what Peter Schiff said about what central banks are doing with gold. Would you trust the New York Fed with 7,000 tons of the yellow metal? How about 1.7 trillion in digital cash? Only 25 basis points separate us from serious price inflation. And Godfrey Bloom shocked us with his comments on the European banking system. Seems outrage at central banks is not a local phenomenon. Finally, we pushed the envelope when we asked why the U.S. went to war with Iraq. And apparently, it was not all about the oil. Thanks for watching. Make sure you come back tomorrow. From everyone at Prime Interest, I'm Perianne Boring. Have a great night.